I'm gonna do a financial analysis of Whole Foods Corporation. This is for Finance 381. This is gonna be the additional company that I chose to do. I'm just gonna run through these 5. That is the dew point analysis, and at the end I'll describe whether I would buy 50% of the company or not. That takes us. Whole Foods is created in 1980. It is one of the largest grocery stores that specialize in organic and hand-grown foods. They reached $3.4 billion last year in 2014. The first ratio that we're going to do is a profit margin. I've done these ratios for the past 5 years of Whole Foods Corporation. It's right under 4 for year 5, but these are the past 5 years. It's gone up, and the profit margin is just showing what percentage of each dollar that they get to keep. It is significantly lower compared to some other industries, but for this industry, a 4% profit margin is around the average for the grocery store industry. The second ratio we're going to be doing is the equity multiplier, like I said, for the last 5 years, and that is just showing what percentage of the company is financed by debt, and so the lower the better. We have lowered it each for the past 5 years. The last year went up, but not significantly. We're right under 1.5 for year 5. And that is going to be the financial leverage of Whole Foods Corporation as well. The return on equity is the third ratio. That is going to be the profitability of revealing how much profit a company generates with the money its shareholders have invested in it. It's going up significantly over the last 5 years. This shows a lot simply because it's consistent. And as an investor, I want a company that is consistent, and their return on equity has gone up. It's sitting right under 15 on year 5. The fourth ratio of the dew point is the return on assets. That's going to be your ROA. It's how profitable a company is relative to its total assets. Being a grocery store, they do have a lot of buildings, and to manage those assets is very difficult. It has gone up the past 5 years, with year 5 being right at 10. The last ratio is the total asset turnover, and that is going to be how efficiently they are managing those assets that they have. That's going to be your sales over your assets. They're pretty consistent. Yet again, that shows a lot for an investor, that they're managing the assets efficiently, and has gone up a little bit over the past 5 years, with year 5 sitting right at 2.5. With that being said, at the end of the DuPont analysis, I would invest into buying 50% ownership of Whole Foods, simply because the company has great growth potential with their stock. Their PE ratio is not significantly high, but it's higher than most. That shows that there's a lot of confidence in investors. They're also very consistent over the DuPont analysis with each ratio. They manage their assets efficiently. The only negative thing throughout Whole Foods is that their profit margin is low, but like I said, that the profit margin for the grocery industry is significantly lower than most other industries, and they are competing with the industry average. So I would buy 50% share of Whole Foods Corporation. Thank you.